I mean, that's really to you, right? JP Morgan said that this is making a new phase of crypto deleveraging that could be induced by this collapse, and you could see cataclysmic selling. Is there a line to be made through this to another part of the market that is more systemic?
I don't think it is systemic to the broader market as 2008 was, but I think there are parallels to 2008, and I'll come back to that in just a minute. The reason why I don't think it's systemic to the broader market or the broader economy is we looked at some of the exposures, and for example, households, U.S. consumers have about a 10% exposure to crypto, or 10% of individuals have exposure to crypto. So it's not like 66% of people who own a home and have a mortgage in the home. So that's different from 2008. You know, the other thing, the big deal, the big difference right now is the banking exposure, and banks have started to maybe make allocations to crypto, but it is $9 billion according to the recent estimates, so it's still a drop in the bucket. And so where the rubber meets the road here is it's the VC community that has financed most of the crypto company expansion, and something like $180 billion of venture capital money was raised to invest in these blockchain and crypto companies. So that's where I think the bulk of the losses are likely to occur, but it's not in the banking system, and the banking system either way is much better capitalized. You know, then we looked at the corporate exposures, we looked at the pension fund exposures, and there are some, but they're still in the very low single-digit percentages. So for all those reasons, that's why I don't think it has to be systemic, and I don't think it's going to have this cascade of, you know, selling pressure that cascades through the broader market. Having said that, I think it is absolutely going to dent some sentiment around tech. Because if you think about these venture capital funds, they're not only investing in crypto, they're also investing in other growth companies. And if they have losses in one part of the portfolio, they might not be able or willing to take that additional risk. So I think the whole VC backing of tech is going to slow down. The multiples will come down. And so the risk appetite in tech is going to come down. And by the way, you know, crypto was a big consumer of things like semiconductors. Yep. So all of that is linked, Guy. I don't think it's systemic, but what really worries me here is that I don't think we truly have the transparency of how much leverage there's in the system and how much packaging there is in the system. And that's what really worries me about here, and that's what brings me back to '08, you know, to the CDO Square type conversations. You know, there's a lot of financial engineering that we're sort of beginning to reveal within crypto, and that is a concern.
How deep do you think it goes?
Sorry, say that one more time.
How deep do you think it could go? If we're comparing it with CDO Squared, then how systemic could this ultimately be? What people are trying to understand is how far does this go? If it stops with the VC community, then it feels containable. If it goes beyond that, then and is linked to other assets, and we were just talking about Tether, and that's meant to be the link to the dollar. If you start to think about how we're compounding at every level the stress, we don't know how far that stress could ultimately go then.
Yeah, and that's what we try to gauge with looking at some of the percentages that individuals and banks and corporates allocate to it. But if you think about it this way, at one point, the cryptocurrency market cap was $3 trillion, and it is around $800 billion today. So that's a significant decline, and that's going to be spread around between probably mostly individuals and some corporate exposures. You know, to put that in comparison, the declines in housing equity, for example, were about $3 trillion. The declines in the NASDAQ back in 2000 were about $4 trillion. So we're sort of on par for those losses, but again, they're not as widely distributed. If you think about that $180 billion in VC funding, once again, that went into, you know, these companies, of course, the valuations of them are much larger. I mean, FTX alone, $32.5 billion valuation. In the last round, that's been written down to zero. So there's absolutely exposures, but again, Guy, you know, the fact that the banks have not participated broadly, the fact that institutional investors have participated but not broadly, and the fact that most of the individual consumers, I mean 90% of them didn't have crypto exposure, the fact that they have been insulated. And by the way, most individuals are not exposed to venture capital. Who invested in venture capital is mostly institutions at this stage. So I think that's what insulates us, but that's sort of how you know, how we sum up and you know, quantify some of these exposures.